Hello and welcome to this very special interview on Money Paathshaala. Joining me today is someone who actually needs no introduction. For more than 3 decades, he has been campaigning for investor education. Now, of course, he is the managing director of Kotak Mahindra Mutual Fund for a few years now, but he's worked across the industry, much admired, and someone who believes in the India story, who takes out a lot of his time to educate investors. At least I've seen that for almost 30 years of my association with him. Nilesh Shah. Thank you very much, Nilesh Bhai. It's always a pleasure talking to you. First question is not trying to give away our age, but if you see our generation, actually, in many ways, missed the Indian equity story. There were very few people who actually invested, and even those who did hardly stayed on for 25, 30 years and, saw the kind of many schemes actually of the mutual fund industry have delivered even more than 20% during this period, compounded annual growth. But when I speak to people like you, most say that, yes, we got investors at different times, but nobody really stayed invested. And I remember we used to say that it's the foreigners, some Mr. Mark or Mary sitting abroad through their mutual funds who actually made the money. Now, why did that happen? There's no point discussing that. We all know why that happened. But today, if a 25-year-old is listening to you, and you keep writing a lot about the potential that India has, and as a result, the Indian markets have. And what would be your advice to a 25-year-old who is listening to you today for the next 25 years?
So, Vivek, bhai, thank you for having me over here. My advice to a young Indian will be keep faith on India growth story. What we saw over 30 years of our career from 90s till today, you are going to see much more in next 10, 20 and 30 years. While on a percentage term, our opportunity may look bigger, in terms of absolute size of money, the opportunity will be far bigger for you than us. We legitimately could face our children today and say that, look, when we were starting our journey of investment, Dalal Street was a wild west. There was no Vivek Bhai available to talk to people about investment. And there were so many uncertainties. And probably our children will forgive us saying that, okay, I can understand you struggled a lot. But when you have to face your children 25 years down the line, 30 years down the line, you will have none of our excuses. Today, there are tools available, there is knowledge available, and please believe in India growth story and be a long-term investor, be a regular investor, be a disciplined investor. Bas ye teen cheez kar le, I'm sure they will secure their financial freedom.
Absolutely. Nilesh Bhai, when the Sensex hit 50,000, and I remember you and I spoke, you wrote a very nice piece of your personal learnings and your personal journey. When from where you started and how, you were seeing the Sensex at 50,000. Today, as we are recording this interview, we have already crossed 66,000. Are you waiting for 70,000 for your next article, or have you, and could you share a little bit of that experience with our viewers? I personally really loved the way you wrote it. It was a very personal account. Share some of those thoughts with our viewers today.
So Vivek bhai, learning does not stop, and like many of people in my generation, I got attracted to stock market during 90s bull run. And there was no knowledge, no wisdom. I invested by borrowing money, hoping that I'll become rich overnight. and I lost all the money. The losing money was a painful thing. And that's where I started seeking knowledge and wisdom. Knowledge many a times is easily available and you can learn on your own. But wisdom is very, very difficult to get. I was lucky that throughout my life, I could go to people who were wise and who were happy to share their thought process. So, in that article, I wrote that in Dalal Street, Lakshmi Pujan happens on the night of Diwali. But Saraswati Pujan you have to do every day. Knowledge and wisdom helps you make money. Lakshmi and Saraswati both needs to be prayed. The second thing he mentioned that like Poonam and Amas are part of nature, Teji and Mandi are part of market. In the worst of Mandi, think that there will be a brighter day ahead with Teji. And in the best of the Teji, always remember that something will go wrong and Mandi will come. The third fantastic piece was Bhav Bhagwan. Price discounts everything. At a price, everything is a buy. At a price, everything is a sell. Don't bet against the market. Market is superior to you. Many a times, we become egoistic as people say, oh, for 30 years you are in market, you are managing lakhs of crore, you are market guru. At that point of time, I always remember that I am a student of the market, not guru. And I have to always learn and relearn. And I can't bet against the market. Market is superior to everyone. One thing which he said that on Dalal Street, when Batata starts trading higher than Tata, it is time to get out. And many times we have seen that Kachra stocks runs, they attract, a lot of investors like I was attracted in the 90s. And invariably the story remains the same. You end up losing your capital. Another interesting thing which he mentioned was that there was a very famous restaurant, Dwarika, on Dalal Street. And he said, their samosas were very famous. He'll say, you won't eat Vasi samosa. You won't eat samosa if they are not of good quality. Then why will you invest in Kachra stock? Always buy quality and stay invested. This kind of wisdom collected based on day-to-day experience taught me that investment is not about, arithmetic and mathematics and Excel sheets. It's all about common sense, which unfortunately is not commonly available. I think investment is very, very easy to understand, but very, very difficult to do. All of us become greedy. All of us become fearful. This kind of wise people can tell us how to maintain equilibrium, how to maintain that balance. In the worst of the bear market, think of the bull market. In the best of the bull market, like today, think of potential bear market. That equilibrium will ensure that your portfolio runs on both accelerator and brake. It will be able to navigate the ups and downs of the market quite nicely.
Nilesh bhai, what is the power of patience? Since we are talking about wisdom, and the good thing, as you said in your opening remarks, is that today there is so much of knowledge available, and when I keep seeing lots of data points that are put out by various market participants, some mutual funds, it all points to one thing that which you've been saying for many years, the power of compounding, but where a bulk of your wealth could actually be made towards the latter half of your cycle of investing. In fact, just the other day, there was a lot of, commentary and data around, say, the mid cap and the small cap space. And I was talking to a financial planner, and he said that, the best part is that this 10-year returns, 2% of that compounding, whatever number is being given, has come in the last 6 months. Now, what is the power of patience, according to you? You talked about, the other pillars, what one has to keep in mind. But I find that While, even during COVID, a lot of young people came into the mutual funds, but maybe more actually started trading instead of, trying to seek a patient way of building wealth over a period of time.
So, Vivek, bhai, if you believe in gardening and you want to plant a mango tree, patience is required. You have to wait for 12 years before mango tree can give you mangoes. And I haven't yet met a person who goes to God and complain that why are you making me wait for 12 years for getting mangoes? Market is also the same. It is not timing the market which makes money for you. It is time in the market which makes money for you. Can a business be created overnight? Answer is no. The seeds which were laid by Sri Jamshedji Tata, that were nurtured by J.R.D. Tata, and it was grown by Ratan Tata over 100 years.
Mm.
A Tata group could not have been created by Jamshedji Tata in just one day. Businesses take time to grow, time to mature. And stock market is nothing but reflection of business value. Of course, in Teji ki market, business value gets exaggerated. In Mandi ki market, it gets decimated. But at the end of the day, stock market is reflection of business value. And business value is like mango tree. It takes time. बिरबल की खिचड़ी है, पकने में समय जरूर लगता है.
Absolutely. Nilesh bhai, the point I alluded earlier about we have been seeing last 6, 7 months, a lot of action in the mid cap, small cap space as well. Again, one finds, and if you look at the data which Amphi, puts out, that you find suddenly a greater flow of folios opening in these schemes. And it almost gives the impression that once again, the younger people are trying to chase, an early or maybe already a fairly highly valued or trying to time the market, as you rightly said. What would be your advice and word of caution? I mean, mid cap or small cap is also a great space to be in, just like a large cap is, and other categories are. But what would be your advice to someone who wants to, just because the space is doing well, jump in and try to take make an investment in this space?
So, to investors, my recommendation will be please go back to March 2020 and look at our funds, small cap and mid caps performance. If I remember the data correctly, Vivek bhai, on a 3-year basis, my SIP returns were negative. On a 5-year basis in small and mid cap, my SIP returns were paltry, marginally positive, but certainly below savings bank account return. And on a 10-year basis, my SIP returns had halved. They were down 50% and they were probably comparable to just bank FD return. If you can bear that slide, if you're not going to redeem or stop your SIP in that turbulent time, then you should invest in small and mid cap funds. As I mentioned, Teji and Mandi will continue. Today, small cap returns looks extremely good because there is Teji in small cap. It's in fact reaching a level where in few micro caps and mini caps, it's becoming euphoric. Many a times we have seen it's easy to manipulate small and mid caps thanks to limited float, thanks to variety of other factors. To investors, please, please, please be ready for ups and downs. Go back and check March 20 performance. If you can withstand that, then you should invest in small and mid cap fund. The best way to invest in small and mid cap is through SIP rather than lump sum. Invest on a regular basis through ups and downs of small and mid cap, and eventually you will benefit out of it.
One final question, Nilesh bhai, while there has been, thanks to all the efforts of people like you, the industry, the regulator, a lot of awareness today about mutual funds, and that's reflecting in the increase in folios, in the increase of AUM. But one of the questions that a lot of people who I speak to, first timers, beginners, they've struggled to figure out what's a good starting point, right? Of course, the best way is to go to an advisor. But unfortunately, especially in tier two, tier three, there are not as many advisors as there should be. Of course, today technology allows you to, do it on your phone, but somebody might want to meet somebody face to face. Now, what according to you, and I know this is generalizing things and that's not what we usually do, but if somebody wants to just wet their feet and they've understood from their ecosystem and knowledge that it's a good way to start, what according to you is a good way for a beginner to get a sense of the market? I mean, is it a balanced advantage fund route? Is it an index fund route? What would you recommend?
Vivek, if you are a beginner, let's say you are three kind of beginner: one very conservative beginner, one average risk taker, and one aggressive risk taker. For the conservative guy, my recommendation is that you outsource your allocation to fund manager and invest in what is known as asset allocation categories. In this kind of funds, fund managers moves between debt, equity, and gold kind of commodity, depending upon their view on the market. They are kind of fill it, shut it, forget it kind of fund. Volatility will be lower and the returns could be better than probably other comparable asset classes. If you are average risk taker, then you can start through SIP in mutual funds, which is large cap fund, large and mid cap fund. If you are aggressive risk taker, then you can start through SIP in mid cap and small cap fund. Depending upon your risk appetite, you can make a beginning. Do what is suitable to you. In cricket, if we see, Virendra Sehwag was a successful cricketer and he was aggressive risk taker. If there was a half volley on first ball, he wouldn't mind hitting it for a 4 or a 6. He was very successful. On the other hand, we had Cheteshwar Pujara or Rahul Dravid kind of player. They are very, very defensive, conservative. They don't take inappropriate risk. They'll, let the ice settle in and then play ball according to the merit. Now, they are also successful cricketers. So do what is suitable to you. Don't try to copy someone else because that's successful. By and large, when you copy someone, it's a disaster.
So run your own race.
Absolutely. I think investors have to be fair to themselves. If in March 20 kind of correction you didn't increase equity, then you are not aggressive risk taker. If in March 20 you got worried and redeemed, then you are definitely very, very conservative risk taker, not average risk taker. Be fair to yourself. That will ensure that you will be able to withstand volatility of the market. In market, everyone knows long-term investing will make money. But when the push comes to shove, people driven by their greed or fear forgets about that. And hence it is important to be fair to yourself. Do what is suitable to you.
Always a pleasure talking to you, Nilesh Bhai. Thank you so much for taking time out from your busy schedule. And I really hope and wish you all the best. May you continue to educate millions of Indians through your words, through your wisdom. Thank you very much.
Thank you, Vivek.